What's going on, everybody? My name's Jose from deepdatainvesting.com, and today we'll be going over the cash flow statement. Quick plug, if you haven't already, go ahead and sign up at deepdatainvesting.com, where we send an email bi-weekly of the things that we've learned about investing so that you don't have to waste your time through trial and error. So what exactly is the cash flow statement and what is it used for? Why is it useful? Well, the cash flow statement records all the changes in a company's cash balance from the current period and previous period. It shows the company's cash inflows and outflows. Simply put, it tracks how much cash has came in or out of a company's bank account. So the cash flow statement is part of one of three financial statements that are super important to know as an investor so that you can make wise decisions about your investments. If you haven't already, go ahead and check out the income statement video where I explain all about what the income statement is and how to use it, and also the balance sheet video where I explain all about that. So again, as an investor, it's important to know how a company manages its cash. You may be wondering, isn't that what the income statement does? Well, not exactly. So cash does not equal revenue and expenses. The income statement uses the accrual accounting method, which records all transactions regardless of whether payment has been exchanged or not. The cash flow statement uses the cash basis accounting method, which only keeps track of transactions that have been realized through some kind of payment exchange. For example, if a company grants customers credit, the customer can buy product or services using that credit without actually paying out cash to the company. And this will be considered as revenue in the income statement, but this is not recorded in the cash flow statement. That is because there was no actual cash coming into the company's bank account. It was all through credit. So the cash flow statement is broken down into three sections: cash from operating activities, financial activities, and investing activities. What you'll see in the operations section is cash flow from all day-to-day operations of a company. In the financing section, you'll see the inflows and outflows of borrowing capital, repaying capital, and raising capital. In the investing section, you'll see the company's cash flow from investments, such as selling or buying investments. Now, most companies use the indirect method to create their cash flow statements. So we'll be using this method because this is the most commonly used. In the operations section, we start off using the net income, and that's coming straight from the income statement. So in order to extract all the cash flows from the net income, we have to make multiple adjustments to the net income. So here are a few examples: adjustments to the depreciation and amortization, adjustments in working capital, adjustments for deferred taxes, and adjustments for gains or losses on disposal of assets. So we need to make adjustments to the depreciation and amortization. By definition, this is just the value that is decreased over the years as the asset is being used, but there's no actual cash leaving the company's bank account because of this. So we need to add this value back because in the income statement, we actually subtracted that value. Next, we have adjustments to the working capital. Now, this is to accommodate for inventory, accounts payable, and accounts receivable. In the case for inventory, say that a company purchased $100 million of inventory the previous year, but in this year, they purchased $120 million worth of inventory. Well, the difference is $20 million of inventory. This is $20 million that left the company's bank account in order to buy inventory. So we need to subtract this value in the cash flow statement. So accounts receivable is literally just money that is owed to the company. It might be from customers or I don't know, some other clients that they have. We need to adjust for this because, like I mentioned in some previous examples that I've used, is that the goods are bought using credit and there was no actual cash that was received by the company. So we need to take that into consideration. So accounts payable is money that is owed by the company. So for example, if a company purchased inventory with some kind of credit, this transaction has not been realized through cash. So no cash has been left from a company's bank account to the supplier or whatever it is. So we need to adjust for that. So the same thing goes for deferred taxes. Now, these are taxes that are left over that the company needs to pay off, but in reality, the company hasn't paid for these taxes, so that the cash is still in the company's bank account. So we need to adjust for that too. There are other things that are included in a company's cash flow statement, such as like unrealized revenue or other current liabilities or other long-term liabilities, things like that. But this is the bulk of what is included in the cash flow statements operations section. Next, we have the financing section. Now again, just like I mentioned, this section covers all the money that is leaving or coming in from either borrowing money or repaying money or raising capital. This may include also things like dividend payouts or repurchasing the company's stock. As you can see, we can see all the numbers in the Microsoft cash flow statement. And so the values that have parentheses around them is actually a negative value. So this is subtracted from the net cash flow, which we'll see further down. Next, we have the investing section. Now in the investing section, we cover cash flows that are coming in from the company's investments. So this is things like purchasing equipment and property or other types of assets. This may include acquisitions of companies, like for example, Microsoft buying GitHub, purchasing of investments like other common stock or treasury bills or bonds, any kind of derivatives, maturities of investments, and even sales of investments. So this is the sale of either assets or other financial instruments. In the bottom of each section, you'll see that there is a net from that specific section. So operations, financing, and investing. Now in the very bottom, you'll actually see a net of this cash flow. This value comes from summing all the values of each section. So for operations, financing, and investing. Now, if you notice this value, this is actually the difference in cash and cash equivalents from the previous period and the current period. So if you go into the income statement, you can do the subtraction there and you'll actually get the net cash flow. The cash flow statement is a pretty straightforward statement that just pretty much shows you the cash coming in or out of a company's bank account and the changes from the current period and the previous period. Now it's important to analyze these three different financial statements in order for you to get a better understanding of how the company is managing its money and how it's performing. If you made it this far, thank you very much for watching. Please subscribe, leave a like, visit deepdatainvesting.com and sign up there once again. If you like this video, go ahead and comment what you've learned in this video or in previous videos of mine. Go ahead and check out the income statement and the balance sheet video for better understanding of what we've covered in this video. Thank you guys for watching. We'll see you guys next time.